Right now, BigBear.ai, ticker BBAI, is trading at $7.18, down 1.51% for the day. While many investors see that ticker and immediately think it's another pure-play artificial intelligence powerhouse set to follow the trajectory of NVIDIA stock, the truth is far more complex and anchored in a world most retail investors rarely see. The immediate narrative is about AI disruption, but the reality is that BigBear.ai's fate is currently written in the ink of government contracts and the tight margins that come with them. The expectation is a high-growth tech company, but the reality is a specialized government contractor trying to convince Wall Street it's something more. This disconnect is where both the opportunity and the significant risk lie. The common belief, echoed across social media and many trading forums, is that BBAI is a small, agile company perfectly positioned to capture a piece of the massive AI boom. People see the .ai in the name and assume it's a golden ticket. They picture a company developing commercial software that will be on every corporate desktop, a competitor to the giants. This is the story that gets traders using the Robinhood app to pile in, hoping for a 10-bagger. However, a deeper analysis reveals a much different picture. The core of BigBear.ai's business isn't selling a slick software-as-a-service product to the open market. It's providing highly customized project-based decision intelligence solutions to the United States federal government, specifically the Department of Defense and the intelligence community. This isn't a flaw, but it fundamentally changes the investment thesis. It's not about explosive, scalable commercial growth. It's about winning large, long-cycle government bids, which are dependent on federal budgets, political wins, and intense competition from massive, entrenched defense contractors. Challenging this mainstream perception requires looking past the ticker and into the company's 10K filings, where the customer concentration risk becomes immediately apparent. This isn't the next Apple stock in terms of consumer reach. It's a highly specialized service provider whose health is tied directly to the spending habits of Washington, D.C. Let's dissect today's trading action to understand the market's current sentiment. The stock opened at $7.29, tried to push higher to a peak of $7.38 in the first hour of trading, but was met with resistance. That early morning pop was likely driven by retail enthusiasm and algorithmic buying that tracks the broader AI sector. However, as the session wore on, the price bled downwards, hitting a low of $7.11 before finding some support. This price action, a failure to hold gains on a day without any major company-specific news, suggests that institutional sellers may be taking profits or trimming positions, while the retail side provides the liquidity. The trading volume is hovering around its daily average, indicating that this isn't a panic-driven sell-off, but rather a methodical grind lower. This is the kind of subtle but telling market behavior that sophisticated traders using platforms like Interactive Brokers trading tools watch closely. It's not the dramatic plunge of a bad earnings report, but the slow erosion of confidence. For anyone managing their portfolio, whether it's through self-investing on a Fidelity mobile app or using managed solutions like Schwab Intelligent Portfolios, understanding this intraday dynamic is crucial. It points to a battle between the story-driven buyers and the fundamentals-focused sellers. This recent movement isn't happening in a vacuum. It reflects broader pressures. The entire AI sector has been volatile. When a market leader like NVIDIA stock catches a cold, smaller, more speculative names like BBAI often get pneumonia. Furthermore, macroeconomic headwinds are a significant factor. The Federal Reserve's stance on interest rates has a disproportionate impact on companies like BigBear.ai that are not yet consistently profitable. The promise of future earnings is worth less in a high-rate environment, which pressures the stock's valuation. Unlike a blue-chip dividend payer you might find in Fidelity ETFs, BBAI is valued almost entirely on its future growth prospects. Any threat to that growth, whether from a hawkish Fed or, more directly, a congressional stalemate over the defense budget, will immediately be reflected in the share price. This is a critical piece of the puzzle for anyone considering an online investment in this space. The excitement of the technology must be weighed against the harsh reality of fiscal policy and monetary conditions. To truly understand the company, it's essential to look at what BigBear.ai actually does. The company operates through its data-driven platforms, Observe, Orient, and Dominate, to help clients make sense of vast, complex datasets and make better decisions. Think of it as a consultancy armed with powerful proprietary software. Their primary customer is the U.S. government, providing solutions for logistics, cybersecurity, and intelligence analysis. They help the military decide where to position assets or predict supply chain bottlenecks. This is incredibly important work, but it's project-based. They win a contract, execute it, and then have to win the next one. This business model is fundamentally different from a scalable software company. They have been making a concerted effort to expand into the commercial sector, targeting industries like logistics, energy, and manufacturing, but this segment is still a small fraction of their total revenue. The company's financial history reflects these challenges. It came to the public market via a SPAC merger in late 2021, and like many SPACs from that period, it has struggled to achieve consistent profitability. Past earnings reports have been a mixed bag, often showing revenue growth driven by acquisitions, but also persistent net losses. The market's reaction to these reports has been telling. Even when they beat revenue expectations, any sign of weakness in their future backlog or margins has been punished severely. This is a stock where guidance is everything. Looking forward, we must frame the future outlook through that lens of expectation versus reality. The bullish expectation is that BigBear.ai successfully executes a pivot. In this scenario, they leverage their sterling reputation within the Department of Defense as a calling card to aggressively expand into the commercial market. They could land a major contract with a Fortune 500 logistics company, proving their technology can compete in the private sector. If they can start stacking recurring commercial revenue on top of their government contract base, the entire financial profile of the company changes. It would finally start to justify the AI growth stock label. A key catalyst to watch for would be the announcement of a significant non-government partnership. Another potential upside is the geopolitical climate. Heightened global tensions often lead to increased defense and intelligence spending, which would flow directly to companies like BBAI. For those building a portfolio on platforms like SoFi Invest, BBAI represents a high-risk, high-reward bet on this successful transformation. However, the reality check presents a more cautious and perhaps more likely scenario. The primary risk is and remains their overwhelming dependence on government contracts. A shift in political priorities, a lost bid for a major contract renewal, or even just a prolonged government shutdown could have a devastating impact on their revenue. Competition is another major hurdle. They aren't just competing with small AI firms, they're up against giants like Palantir, which has a significant head start in both the government and commercial sector, as well as the internal AI development arms of behemoths like Lockheed Martin and Northrop Grumman. Furthermore, the path to profitability remains uncertain. The company may need to raise additional capital, which could lead to shareholder dilution. For an investor using a broad fidelity wealth management strategy, BBAI might represent an unacceptably high concentration of risk tied to a single customer segment. The bearish reality is that BBAI remains a niche government contractor that struggles to achieve the scalable, high-margin growth the market expects, causing its valuation to compress over time. It's a classic case where the story is compelling, but the business model has yet to prove it can deliver on that promise. Comment below what you believe is the single biggest risk facing BigBear.ai in the next 12 months. In conclusion, the story of BigBear.ai is a fascinating study in market perception. The expectation, fueled by the .ai in its name, is of a disruptive tech company on the verge of exponential growth, a smaller sibling to the giants of the sector. Investors using accessible investing sites see the low share price and dream of outsized returns similar to early investments in companies like Tesla stock. But the underlying reality is that of a specialized government contractor with deep expertise, but also deep-seated dependencies. Its stock price movement reflects this constant tug-of-war between the AI hype and the fiscal realities of federal contracting. The intraday volatility, the sensitivity to macroeconomic news, and the critical importance of contract announcements all point to a company whose path is far from certain.
The ultimate success or failure of an investment in BBAI will depend not on the broad AI trend, but on management's ability to navigate the complex world of government procurement while simultaneously breaking into the fiercely competitive commercial market. Understanding this distinction, the expectation of a tech revolutionary versus the reality of a specialized service provider, is the only way to make an informed decision.